For years, the standard advice was obvious. Do not pay off your mortgage early. Invest instead. And the reason was simple. If your mortgage rate was 3% and the stock market could return 8% to 10% over time, then investing the difference gave you a huge spread. You borrowed at 3%. You invested at maybe 8%. The gap was 5 percentage points or more. Over 20 or 30 years, that spread could compound into hundreds of thousands of dollars. So when people said don't pay off your mortgage early, they were not always wrong. In a low-rate world, they were often right. But here is the problem. A lot of people are still repeating that advice as if mortgage rates never changed. They are using 2021 logic in a 2026 economy. And that is where people get crushed. Because when your mortgage rate jumps from 3% to 6.5% or 7%, the math changes completely. A 3% mortgage is cheap debt. A 7% mortgage is not cheap debt. At 3%, the stock market does not need to do anything extraordinary to beat your mortgage. At 7%, the market has to work much harder after taxes, fees, inflation, and human behavior. That is the part most people skip. They compare a guaranteed mortgage cost to a theoretical market return. But your mortgage does not charge you theoretically. It charges you every single month. Let's make this simple. David and Ryan are both 35 years old. They both earn $90,000 a year. They both buy a $400,000 house. They both put 20% down, which means they each take out a $320,000 mortgage. They both get a 30-year fixed mortgage at 6.75%. Their monthly principal and interest payment is about $2,075. And after paying all their bills, they both have an extra $500 a month. Same age, same income, same house, same mortgage, same extra cash. The only difference is what they do with that $500. David puts the extra $500 toward his mortgage principal every month. Ryan makes the minimum mortgage payment and invests the $500 into an S&P 500 index fund. On paper, Ryan sounds more sophisticated. He is investing. He is compounding. He is letting the market work. David sounds more conservative. He is just paying down debt. But at a 6.75% mortgage rate, David is not just paying down debt. He is locking in a guaranteed 6.75% return on every extra dollar he sends to the lender. And that changes everything. When David sends an extra $500 to his mortgage, that money reduces his principal. That means the bank can no longer charge him interest on that $500 for the remaining life of the loan. If his mortgage rate is 6.75%, then avoiding that future interest is economically similar to earning 6.75% guaranteed. Not maybe, not if the market performs, not if the economy cooperates. Guaranteed by the loan contract. That is the part people miss. The stock market gives you a possible return. Your mortgage gives you a guaranteed bill. And eliminating a guaranteed bill creates a guaranteed benefit. Now compare that to Ryan. Ryan invests $500 a month. If the market performs well, he may come out ahead, but his return is not guaranteed. The S&P 500 might average 10% over long periods, but it does not deliver 10% in a straight line. It can drop 20% in a year. It can go nowhere for years. It can crash right when Ryan loses his job. And even if Ryan does well, he may owe capital gains tax when he sells. David's mortgage payoff does not come with a capital gains tax bill. He does not need the market to behave. He does not need to time anything. He just needs to keep paying. That is boring. But boring is not the same as stupid. In the first 5 years, Ryan may look like the smarter one if the market is doing well. His brokerage account is growing. He can open an app and see his portfolio balance. He feels like he is building wealth. David's progress looks less exciting. He does not have a flashy portfolio. He just has a mortgage balance that is falling faster than scheduled. But the difference is reliability. David's extra $500 works every month. January it works. February it works. During a bull market, it works. During a bear market, it works. During a recession, it works. Every extra payment reduces future interest. Ryan's $500 only looks brilliant if he actually invests it consistently and leaves it alone. That sounds easy in a spreadsheet. It is much harder in real life because real life does not move in clean assumptions. The market drops 18%, and Ryan starts wondering if he should pause contributions. His car breaks down and he skips a month. He gets a bonus and says he will invest it, but spends half of it. His portfolio falls for 6 months, and he starts checking it every day. This is why the best strategy on paper can fail in real life. David's strategy has one hidden advantage. It removes temptation. Once the money goes into the mortgage, he cannot easily panic sell it, spend it, or gamble with it. It becomes forced wealth building, and for a lot of people, forced wealth building beats perfect theory. This is where most financial advice gets lazy. It assumes people behave like calculators. It assumes Ryan will invest $500 every month for 30 years. It assumes he will never panic. It assumes he will never sell during a crash. It assumes he will never skip contributions. It assumes he will never use the brokerage account as a lifestyle fund. That is not how most people behave. Most people do not invest the difference. They spend the difference. They upgrade the car. They renovate the kitchen. They take the vacation. They tell themselves they will catch up later. And later becomes 10 years. David does not have to be a perfect investor. He just has to keep making the extra payment. That is why mortgage payoff can be powerful for people who need structure. It turns financial discipline into a system. No motivational speech. No market timing. No constant decision-making, just a balance going down. And sometimes the strategy you can actually follow beats the strategy that looks better in a spreadsheet. A mortgage is not just debt. For most families, it is the largest fixed expense in their entire life. That matters more than people think, because wealth is not only about how much money you have. Wealth is also about how little money you need to survive. Ryan may have a brokerage account, but every month the bank still wants its payment. If Ryan loses his job, the mortgage does not care. If the market crashes, the mortgage does not care. If his income drops, the mortgage does not care. The payment is still due. David is attacking that fixed expense every month. He is not just increasing equity. He is reducing the future pressure on his life. When the mortgage is gone, his required monthly expenses collapse. That gives him options. He can take a lower paying job. He can start a business. He can retire earlier. He can survive a recession with less fear. He can help his family without being crushed by a bank payment. That kind of flexibility does not always show up in a net worth calculator, but it shows up in real life. A person with a paid-off house and low monthly expenses can survive storms that destroy people who look richer on paper. Investing can make you richer. Paying off your mortgage can make you harder to break. Ryan's investment account has another problem: taxes. If his $500 monthly investment grows over decades, that is great. But when he sells, part of that growth may be taxable. Capital gains tax reduces the real return. State taxes may reduce it further. And if he sells during a bad year because he needs cash, he may be locking in losses or selling at a terrible time. David's mortgage payoff does not create a tax bill. The benefit is simple: less interest paid, more equity, lower debt. Now, yes, some homeowners benefit from the mortgage interest deduction, but not everyone itemizes. And even when they do, a deduction does not make interest free. Spending $1 to save a fraction of a dollar in taxes is not a wealth strategy. Do not let tax language confuse you. A deduction reduces the pain, it does not erase the cost. Paying off your mortgage before investing makes the most sense when your mortgage rate is high. If your mortgage is 7% or 8%, every extra dollar you pay down is eliminating a very expensive guaranteed liability. That is hard to beat. It also makes sense if you are within 10 to 15 years of retirement, because retirement is not just about having assets. It is about controlling expenses. Going into retirement with no mortgage can dramatically reduce the amount of income you need every month. That reduces pressure on your portfolio. It reduces sequence of returns risk. It gives you more breathing room when markets fall. It also makes sense if your income is unstable. If you are self-employed, commission-based, or working in a volatile industry, lowering fixed expenses can be more valuable than chasing a slightly higher expected return. And it makes sense if you know yourself. If you are not actually going to invest the difference, then stop pretending. Paying extra toward the mortgage is not perfect, but it is better than spending the money and calling it a strategy. But this is not a religion. Paying off your mortgage first is not always the right move. If you have a 3% or 4% mortgage, do not rush to kill it just because being debt-free feels good. That debt is cheap. In that case, investing probably wins over the long run. If you have credit card debt at 20% or more, pay that first. A 7% mortgage is not your emergency. A 24% credit card balance is. If you do not have an emergency fund, build one before throwing every spare dollar into the house. Home equity is real wealth, but it is not liquid. You cannot buy groceries with drywall. You cannot pay a hospital bill with your foundation. To access home equity, you may need to sell, refinance, or borrow through a HELOC. And if you lose your job, getting approved for a HELOC can become much harder. So do not trap every dollar inside your house. If your employer offers a 401k match, capture it before paying extra on the mortgage. A match can be a 50% or 100% instant return. Skipping that to chase a 6.75% mortgage payoff is not discipline. It is bad math. This is where many people mess up. They hear pay off your mortgage and turn their brain off. Do not do that. Order matters. Here is a practical framework. First, pay off high-interest consumer debt. Credit cards, payday loans, personal loans, anything charging double-digit interest. Second, build an emergency fund. At least 3 to 6 months of essential expenses in cash or a high-yield savings account. Third, get your full employer retirement match. Do not leave free money on the table. Fourth, look at your mortgage rate. If your mortgage is below 5%, investing is usually the better long-term move. The spread is still wide enough. If your mortgage is above 7%, paying extra principal becomes very attractive. That is a high guaranteed return. If your mortgage is between 5% and 7%, split the difference. Put part of your extra money toward the mortgage and part into investments. That gives you both guaranteed debt reduction and market upside, security and liquidity, lower future expenses, and long-term compounding. You do not have to be a fanatic. You do not have to pick a team. You have to run the numbers. The real problem is not that people invest. Investing is powerful. The real problem is that people repeat old advice without checking whether the assumptions still apply. Always invest instead of paying off your mortgage is not a law of nature. It is a conclusion based on interest rates, market returns, taxes, risk, time horizon, and behavior. Change the rate and you change the answer. At 3%, paying off the mortgage early often loses. At 7%, it can win. At 8%, it may be one of the best risk-adjusted moves available. In between those numbers, the answer depends on your life, your job stability, your emergency fund, your retirement timeline, your tax situation, your ability to actually invest consistently. That is the part no viral TikTok can answer for you. So should you pay off your mortgage before investing? Not always. But if your mortgage rate is high, if your income is unstable, if you are close to retirement, or if you know you will not actually invest the difference, paying down your mortgage may be smarter than people want to admit. Because the stock market can make you wealthy, but a paid-off house can make you unbreakable. The real question is not, should I invest or pay off my mortgage? The real question is, what guaranteed return am I giving up by not paying it down? If your mortgage is 3%, investing probably wins. If your mortgage is 7%, paying it down may be the smartest investment you can make. And if you are somewhere in the middle, split the difference. The biggest mistake is not choosing the wrong side. The biggest mistake is taking advice from a different interest rate world and pretending it still applies to yours.